So in this video, I'll be answering some of the really great questions that I've been getting from you guys lately. We're gonna go through a handful of these to see if we can shed some light on the things that you want to know the most, starting with this question here from Gabrielle, who asks, if you were starting from scratch, which stocks would you buy? And that's a really great question. So for starters, if I had to start investing from scratch all over again, I would do things a bit different than how I actually did it. When I first started investing, I went all in on individual companies, some of which I still do own today, like Chevron, Procter & Gamble, and Starbucks, which have all worked out pretty well for me. But with that said, on the other hand, some of the initial stocks that I bought turned out to be not great investments, like 3M, AT&T, and Verizon, which are all my biggest losers so far. Now, when I first got into investing, I was practically a blank slate. I really didn't know what I was doing and didn't at all know what to look for in an investment, and that's not the type of individual that should be picking stocks. So if I had to start investing all over from scratch, this time around I would take a much more hands-off approach, and I would put 100% of my funds into ETFs. I'm a big fan of the SCHD/VOO combo. In fact, that's what I'm rocking with in my Roth IRA, and I invest into both of those funds every single week. I think something like that would be a great place to start for any brand new investor, and it doesn't have to be SCHD and VOO or VOO either. By the way, there are plenty of other great ETFs out there like VYM, VIG, VTI, and DGRO, just to name a few. The ETF approach would have been just so much easier to manage than all of the individual companies I started out with, and in general, it would have given me the best of both worlds between having skin in the game and, getting the ball rolling with my investing journey while also being well diversified. And I think this approach would be the investing equivalent of learning how to walk before you can run, which in hindsight, I think can save you from making a lot of mistakes. But anyway, guys, moving on to this next question here that asks, wouldn't it be a lot simpler to just invest in a high yield savings account at like 5% and make the same amount per month? And this is another really great question. In fact, this is probably one of the most common questions that I get. And here's my take on the matter. While putting your money in a high yield savings account is definitely a safe and attractive option in the short term because you don't have to worry about losing money, and the relatively high interest rates we're seeing create pretty nice yields, I still think it's important to consider the bigger picture from a longer term perspective. Over time, dividend paying companies tend to increase their dividends on a regular basis. Usually every single year you'll see a company raise their dividend at least once. At least that's the hope, and those are the type of companies you'd want to invest in. And as an example, we can look at a company like Lowe's. They've raised their dividend every year over 50 years straight, and by no small amount either. I mean, their average dividend growth rate over the last 10 years has been 20%, which is ridiculous. And this is something you will never get from a high yield savings account. You won't be able to benefit from these increasing payments over time. And when you combine the power of this dividend growth along with dividend reinvestments, as well as share price appreciation over the long term, the total returns, as well as the total amount of income that you would receive from investing in dividend stocks, will far outpace the returns you'd get from high yield savings accounts. With that said, though, I still do think a high yield savings account is pretty great, and it can certainly have its purpose. For example, if you're saving for some short to medium term financial goal, like a down payment for a house, maybe you're saving for your wedding or just a vacation fund, then a high yield savings account may be the best way to go. I personally stash money away in one of these every month for this exact purpose. This is my vacation fund, and my fiance and I actually dipped into this to pay for our honeymoon recently, so I'm glad it was there and I'm glad I had it. But if you have long-term goals like many of us here who are working towards financial freedom 10, 15, 20 years down the road, then I think investing in the market will be a much more effective way to reach that goal. And with that, guys, this brings us to the third question of the day, which asks, which metrics are important to look at when analyzing a dividend stock apart from its dividend metrics? Okay, so for this question, we're just going to stick to some of the company's financial metrics outside of the dividend stats. And for those, there are a few key ones to consider. The first one is pretty straightforward. It's revenue and earnings growth. You want to see growth in both of these departments over the years because a growing business will be more likely to sustain and potentially increase their dividend payments, like we were talking about earlier, that dividend growth. You definitely want that. Plus, earnings growth tends to lead to share price growth over a long period of time. Now, the next thing you want to look for are stable, or better yet, growing profit margins. And the higher the margins, the better. High profit margins could be a sign that the business has a durable competitive advantage, which would allow it to charge higher prices for its products compared to what it costs the business to make the products. On the flip side, if a company doesn't have a durable competitive advantage, then we're more likely to see it have lower profit margins, because if they don't have a durable competitive advantage, then they may have to be competitive by lowering their prices. And if they lower their prices and they're selling things for less, that's going to cut into their margins. As a very general rule of thumb, and there are exceptions to this, companies with gross profit margins of 40% or more tend to have some sort of durable competitive advantage. And once again, there are certainly exceptions to that. But anyway, if the margins are less than 40%, it could mean that the company is in a competitive industry. At any rate, the third thing to look for is ample free cash flow. This is extremely important, especially when it comes to dividend paying stocks, because a company pays its dividend from the free cash flow. So if a company's not generating any free cash flow, then it might resort to borrowing money to continue paying dividends, or it might have to reduce or eliminate the dividend altogether, neither of which are good things. Now, putting all of this together, one company that checks all of these boxes for me is Visa. Looking at Visa's income statement over here on Seeking Alpha, if we just start here with the total revenues, we can see that over the last decade at least, they've been increasing their sales pretty consistently. So this is that first box check for us. And the next thing here, the margins, starting here with the gross profit margins for Visa, these are incredible. We can see that across the last 10 years, it's been well above that 40% mark that we're looking for. Visa's margins are just incredible. Their gross profit margin hasn't dipped below 96% over the last 10 years. And we can scroll down their income statement looking at their operating margin here, which is also impressive. This hasn't gone below 64% over the last decade. So this is looking really great. And if we scroll down even more, looking at their net income margin closer to the bottom line, this is still above the 40% mark, which is where we'd want to see the gross profit margins at. So yeah, Visa's crushing it in terms of profitability. And now jumping over to Visa's statement of cash flows, looking at the free cash flow per share, we can see that this has trended pretty much in the same direction as everything else. Up and to the right, their free cash flow per share has been growing over the last decade, which is great to see. And this has translated to some really strong dividend growth. Looking at Visa's dividend history over the last 10 years, guys, it's pretty much exactly what you'd expect. Really strong growth, with no signs of slowing down. And over the last 10 years, they've grown this dividend by a compound annual rate of 18%, which is very unbelievable. But yeah, guys, overall, when it comes to a company's financials, I would say that Visa, at least for me, is like the gold standard. It doesn't get any better than that, in my opinion. But anyway, guys, moving on to this fourth question here from my friend Will. He asks, long story short, I am a 24-year-old investor that is investing around $300 to $500 per month. I plan on retiring early, hopefully, and I'm unsure on whether to prioritize my taxable portfolio or my Roth, even though I can't touch it until 59 and a half. It's just hard to make a solid decision based on what I see on social media, especially considering I'm not sure of all the factors that play into it. Any tips? And this is such a great question, and I had these same exact thoughts when I first started investing. And first and foremost, I just gotta say, hats off to you for starting to invest so young. I think that's incredible. Now, with that said, at only 24 years old, I don't think retiring early is out of the question for you at all. I think that if you're dead set on doing that, and if you have a realistic plan for it, then it could possibly make sense to put more money into your taxable account, which I think is a very unpopular thing to say. And obviously, too, keep in mind, I am absolutely no tax expert. This is just my extremely novice opinion, so just take it at that. But anyway, in my first few years of investing, that's exactly what I did. I contributed way more to my taxable account than my Roth IRA. But a couple of months ago, I decided to change course, and now I actually put more into my Roth than in my taxable. Now, for you, I think the important thing to keep in mind is this. Even though you want to retire early, which I don't blame you, you'll still be 59 and a half years old someday. You're still going to get there. And at that point, once you reach that age, you're going to want as much tax-free income as you can possibly get. And 35 years of tax-free compounding is a pretty sweet deal, and you should take advantage of it. It's also important to keep in mind that, dude, you're only 24 years old. So much is going to change between now and whenever it is you plan to retire. You don't know what your life is going to look like. You don't know what your expenses are going to look like 20, 25, 30 years down the road. So much is going to change. And your investment strategy and what you want out of your investments will probably change over time as well. Now, when it comes to your Roth IRA, even if you don't start by maxing it out initially, I still think it's an important thing to have. And I still think it's an important thing to contribute to for, your future self. I think your future self will thank you if you put as much into your Roth IRA today as you can. Now, once again, even if you don't start by maxing it out, I think that's a good goal to work toward. And I think that's probably going to be the compromise here. And with that said, no matter if you're investing in a taxable account or in a Roth IRA, if you're not sure which stocks you should be buying, then check out this next video right over here. In this one, we're going to be taking a look at 20 different dividend paying companies. I guarantee you'll have heard of all of them before. These are all really great ones to consider if you're a brand new investor just starting out, because they're all going to be pretty familiar. So click right over here to check them out, and I'll see you in the next one.